Recently, we had a PowerOptions subscriber ask us how could they create a synthetic stock search using the tools on PowerOptions. Well, let's go ahead and cover that for everyone right now. What is a synthetic stock position? Well, it's a way to mimic the profit and loss of buying shares of stock using options. We will buy a call and sell a put at the same strike price typically and the same expiration date. If done at a credit, we can have a lower cost basis and a lower break even. Here's an example from March 30th, 2021. We could buy shares of AT&T at $30.39, or we could buy the 21 May standard expiration 30 strike call for 86 cents. And at the same time, sell to open 21st May 30 strike put for 98 cents. This would give a small net credit of 12 cents. So if we did decide to take ownership of the stock at May expiration, we'd only have a cost basis of $2,988 as opposed to $3,000 or $3,039 for 100 shares. How does it work? Well, effectively, we have two ways to potentially buy the stock at $30. At May expiration, if the stock stays above $30, we could exercise that 30 strike call. We buy shares of stock at 30, we keep the 12-cent net credit, our put expires worthless, and we have a cost basis of $29.88. If the stock falls below 30, our put would be assigned. We'd be forced to buy shares of stock at 30. The call expires worthless. However, we keep that 12-cent net credit, so we have a cost basis on our shares of AT&T of $29.88. Is that 12 cents free money? No. Unlike a put vertical spread, a bull put credit or a bear put debit, the purchase of the call option does not cover the obligation of our sold put. Just as if we sold a put on the market, we'll still have to put up the margin for that obligation. This might be either the full amount as a cash secured put. If we sold one contract, we'd have to put up $3,000 to cover the obligation to potentially buy shares of stock at that price. Or you could use the percent margin on a naked put. The customer we talked to was using about a 50% margin, so they only have to put up $1,500 for one contract. However, in both cases, that should be less than the cost of buying the stock outright, as we would typically be using an out-of-the-money put in the synthetic long position. What are the advantages? Well, we potentially have a lower cost basis and a lower break-even than purchasing the shares of stock outright. We can use margin for a much lower cost basis, and we can take advantage of bullish movements in the underlying stock using leverage or just the cheaper cost basis if we put up the full cash secured amount for that put. What are our disadvantages? Well, it still has unprotected risk to the downside, just like buying shares of stock outright. You can use margin. Why is this a disadvantage? Because if the stock suddenly falls, it may result in a margin call if the put is assigned early. Many of the opportunities we see for this are on dividend-paying stock. The put premium takes into account the potential dividend paid over the expiration period. The call does not. But since we're doing a synthetic, we don't own the stock, so we don't get the dividend. Is there a search for synthetic stocks on PowerOptions? No. But there is a strategy that combines buying a call and selling a put that you can search for. This is the short collar position. In a short collar position, we'd sell or short stock, sell a put against it, a covered put position, the opposite of a covered call, where we buy the stock and sell a call. Here we short the stock and sell a put. And then we buy a call for protection if the stock moves up, because the short stock would be losing more money. But since this structure does include selling a put option and buying a call, we can use the short collar strategy to create a screen. We're going to ignore the short collar return columns, risk columns, and other stock columns. And we're just going to view the long call and short put together. Let's go to PowerOptions and see how we could do this. To create my synthetic long stock search, we'll use the short collar strategy. If you do not see the short collar as one of your available strategies, simply click on the Other Strategies tab and pick the short collar from the list and add it to your active menu. Then simply save the configuration, and now you can access the short collar tools. We're going to simply go into the search tool, and this will pull up one of our default searches that we have in the background. Here we see some potential short collar positions that match our default screen and initial value set. We're going to change that. We're going to simply click Clear Filters and empty out the entire criteria set for the options and for the stock technicals and fundamentals. And now we'll put in our basic changes. I'm going to leave the call expiration date and the put expiration date at all expirations. But we're going to want to go further out in time. So let's go ahead and screen for a time frame between 30 to 65 days for the call and the put. Now we're going to select our call expiration date to be equal to the put expiration date as well. Now I do want to look for a positive net credit. I want to look for positions where the short put has a higher premium than the call I'm buying to receive a credit. We're going to do this in two different ways. One is our time value ratio. This is the time value of the bought option divided by the time value of the sold option. If I want to see a net premium, I want this value to be less than 1, where the time value of the bought option is less than the time value of our sold option. We can also make sure to put in a net premium down here in the price and strike price fields to be greater than, say, 15 cents. So we're assuring that we're getting at least 15 cents or more for the sold put than we are for the bought call. Now, I had mentioned that you typically want to do this with a short put that's out of the money. So I'm going to tell the system to show me puts that are a percentage out of the money of at least 0 to maybe 2 or 3%. Not go too wide with this, just want to be kind of at the money. But I don't want to start with an in the money put, which may risk early assignment. I want to start out of the money. And of course, I do want to make sure that the call strike is equal to the put strike price as well. And it never hurts to put in any kind of liquidity. We're just going to look for a call volume of greater than 0 and a put volume of greater than 0 traded today. Let's put in a basic call open interest of greater than 10 contracts, as well as a put open interest of greater than 10 contracts as well. Now, I might want to put in some basics for the stock criteria. This is a synthetic long stock, so I might use some basic criteria that are very similar to what I would use to buy shares of stock. What is my account size, especially if I'm doing a full cash secured put rather than using margin to cover that obligation. So we'll go into the fundamentals first. And let's just put in a basic stock price range of, say, $10 to $250. And I might look for a good mid to large cap stock. We see here that this one is measured in millions. So what I want to do is put in a mid to large cap. Let's just use greater than 2,500 for our market cap. And of course, we can also choose to avoid stocks that have an earnings date between now and expiration. We're just going to leave that alone for now. Now let's go into the technicals. I might want to look for a good average stock volume, stocks that trade on averagely 750,000 shares per day. And at the same time, I'm going to look for a stock in an uptrend, just trading above its 50-day moving average. Now, we have some basic criteria in of what we would look for. Let's go ahead and click Submit. Well, we have several results that came up and matched our criteria. about 9 results, some duplicates. Many of these are dividend-paying stocks, it looks like, as I mentioned earlier, with the exception of GameStop. We have a lot of data in here for things such as maximum risk, percent maximum risk, percent max return. This is all related to the short collar structure, which we're not interested in. So what we're going to do is go into Add Remove Columns, and we're going to clear out some of the unnecessary criteria that we wouldn't look at in the short collar position. We could take out the percent probability assigned. I do want to leave in the net premium. We're going to take out the maximum risk, the maximum return for the short collar, percent return if unchanged, percent to break even, which includes those prices as well. Now I could add in other concepts that I wanted to see for the call or the put. If I wanted to see the option volume, we could simply check that and add that in. The time value, for example. Some other things I'm definitely going to be interested in. We already mentioned the net premium, of course. I might be interested in that time value ratio since that's one of my filters. And I'm going to add in the call option bid-ask spread and the put option bid-ask spread, as our net premium is based on midpoint. Now I can remove some of the stock filters as well. I could take out the ex-dividend date, take out the annual dividend, for example. Might be more important in the short collar. But if you wanted to see other things such as the simple moving average, average volume, market cap, you could just add those in as well. Before we go ahead and submit it, I'm going to change my column order very quickly. So to change the column order, I want to see the call option bid-ask spread next to the call option ask price. And I want to move that put option bid-ask spread right next to the put option bid price. And I'll put the time value ratio right next to the net premium as well. Now we just submit and save and refresh our pages. We have the same type of data that we were looking at before, but we just removed all of the return fields and other fields we didn't need that were related to the short collar, because we just want to pay attention to the ask price and the bid-ask spread for the call, and the bid price and the bid-ask spread for the put, which will give us midpoint net premium of the positive ranges that we had requested, and of course our time value ratio as well. Now this is still a short collar field. However, if I want to view the profit and loss chart for what my synthetic long stock would look like, simply use the More Information button, go to the profit and loss chart, and what I'll do now is clear the short stock position in the first listing for the trade structure. Then we resubmit, and here we have our synthetic long position for AT&T using the 21 May 30 call for our example and the 21 May 30 put as well. A net credit now of 24 cents with the stock trading at 30.27. We would have to put up the monetary requirement of $3,000 if this was a full cash secured position rather than using margin to cover the obligation of the short put. But our effective cost, if we decided to take ownership of the stock by exercising the call at May expiration or being assigned on the short put, would be $29.76, good 50 cents less than the cost basis of the current stock position. Gives us that slightly lower break even on the position as well. So that is the simple way where you can use the PowerOptions tools to mimic a synthetic long stock position. Go to short collar, clear out the filters, go into the options, set your expiration time frame for your desired synthetic long stock position, and set the call and put expiration to be equal. Put in a positive net premium, that field down there in the price and strike price section of the options category. Put 15 cents, 20 cents, whatever your preference, and put in that time value ratio of less than 1. Never hurts to put in some basic liquidity for the option volume today and the total open interest, and use that put percent out of the money field to start the position off with an out of the money put, so you don't need to worry about potential early assignment by using an in the money put with an out-of-the-money call for your synthetic long stock position. Put in some basic stock, technical, and fundamental data as well, the same criteria you would use if you were looking to buy a long stock position. Once you've created your search and have your results, you can view the profit and loss chart of your synthetic long stock position, link to the profit and loss chart through the More Information button, clear out the short stock position on the first line of the trade entry, and now you have the P&L for your synthetic long stock position that you identified using the search. Small disclaimer, Ernie, myself, and other PowerOptions staff members do not use synthetic stock positions in our portfolio. We do not advocate using the synthetic stock as a replacement for the radioactive trading married put approach. All of the positions that we post in the Fusion portfolios based on the blueprint, education, and materials are done by purchasing shares of stock and purchasing the put. We don't use synthetic stock positions for other standard collars, covered calls, or any position that involves buying stock. But if this approach of the synthetic long stock appeals to you, you can use the short collar screen on PowerOptions to create a synthetic long stock screen. Simply clear out the filters, set the data as we had suggested there in the previous slides, and then change your columns as well to just reflect important data for the call option you're buying, the put option that you're selling, maybe that time value ratio, and more. And of course, as always, if you have any questions about setting up the synthetic stock screen using the short collar, send us an email, give us a call, or schedule a coaching session.